This video is made in partnership with the Daily Upside. Visit the link in the description to learn more. Sometimes I like looking at investing backtests to see all the simple ways I could have become a millionaire in the past few years. It's an incredibly sad hobby. Okay, like hindsight is 2020, right? You know, it's funny, you can read about the psychological reasons why hindsight is 2020, but it really doesn't make you want to throw yourself off the top of a Starbucks any less. I don't know why. It's kind of ironic. The first piece of investing wisdom most people learn is that past performance doesn't predict future results. The kind of insurance policy plastered onto every chart with a line going up. Add, I'm not a certified financial advisor, this is not financial advice, and you've armed yourself with the tools to say whatever you want with zero repercussions online. Yes, past performance doesn't predict future results, but what's the alternative for predicting future results? Fucking economic forecasts? That's like having to pick between the electric chair and, well, economic forecasts. Aren't those also based on the past? Past performance is not a reliable indicator of future results. So what is all of this research for again? It's like we're gonna build all of this research on this one fundamental assumption and then tell you that assumption is not reliable. Maybe you could research something that is a reliable indicator of future results. I'm joking, obviously the past is the most reliable thing we have to go off of, and it's more of a legal disclaimer for any misled investors who think good returns in the past means good returns in the future. I just think it's funny when you get down to what this statement is actually implying. None of this actually matters because the fundamental assumption this is all based on is somewhat unreliable at best. But here you go. Didn't Churchill say those who fail to learn from history are condemned to repeat it? Maybe we can just stop learning about the stock market and then it will repeat the returns of the last 10 years. I don't feel funny today. Everything is so simple in hindsight. I wish I could just live in hindsight. How much easier would that be? The economy in the past is a simple system. Causes and their associated effects appear linear, obvious. It's almost like you can draw a line between them. The economy in the future is fucking chaos. Doesn't the Shiller PE ratio predict negative market returns anytime it's above 25? Well, that model is outdated because it doesn't account for changes in interest rates. Belief in one's ability to exert control over the environment and to produce desired results is essential for an individual's well-being. It has repeatedly been argued that perception of control is not only desirable, but also probably a psychological and biological necessity. Isn't it funny how your brain will make every attempt to find control in things that are fundamentally unpredictable just to keep you from self-destructing? Like you'll much sooner draw magical bull patterns on a chart than admit, maybe I don't know what I'm doing here. When I venture out into the world of investing backtests, I like to keep a few things in mind. What appears in retrospect to be simple cause and effect is actually more like this. And the defining question of all of this is, why do the line go up? This one goes up, around $11.9 million. This line is the theoretical growth of 100,000 into over 11 million in 10 years. Compare that to the S&P that returned 300% in the same period. I'll link this in the description if any of you want to read it. They basically backtested an index put spread strategy starting in January of 2010, combining different long and short strike selections, days till expiration, and stop losses. You could theoretically recreate this massive return. The strategy is simple. You could even do it in Robinhood. Take SPY, multiply its current price by 0.92, buy a 7-day put at the nearest strike, then sell the furthest out of the money put strike that allows you to collect 3% of the position's max loss in premium. Set a stop loss at 5% of the position's max loss. This should turn 10,000 into roughly 1.1 million in the next 10 years, right? But wait, we're neglecting our defining question. Why do the line go up? Take 50 variables, test random combinations of them, and you're bound to find something that looks like a money printer. Technical astrology analysis backtests are usually the biggest perpetrators of this. Business fundamentals are the opposite of technical analysis, and reading the Daily Upside has helped broaden my business knowledge. One thing I really like about this newsletter is the Sunday deep dive. The most recent one was about the rise of mental health apps, something that if you didn't already know about, you'll probably be learning about soon enough. enough. I really like reading these because they give me a basic understanding of a business that I know nothing about. Hackers stealing user data and then using it to blackmail them. That's a big risk factor I'll know to look out for when I start my mental health app. Lost Space. In all seriousness, the business knowledge I've pulled from reading this newsletter for a while is really substantial. Not only is it entertaining, but I feel like I learn something every time. You can subscribe to the Daily Upside using the link in the description. It's 100% free and you can always unsubscribe if you don't enjoy it. Despite the many jokes about technical analysis I've made on this channel, I don't like to entirely rule out anything. You can find a lot of technical indicator strategies that show promise, but it's often difficult to explain why the line do go up. This 12 million% return is a great way to demonstrate how backtests can be misleading. This one was intentionally overfit to produce huge outperformance. Using a cluster of technical indicators was able to generate almost a 70% compound annual growth rate. One workaround for solving this overfitting problem is testing using out-of-sample data. For example, you take 10 years of Amazon's intraday stock data and use the first 3 years of it testing the Jerome Powell bull ride formation. If it beats buy and hold, test its performance using data from the 4th year. You then repeat this process until you have a breakdown of in and out of sample performance. While still not bringing a clear answer as to why the line is going up, this prevents your model from getting fitted to the noise of your dataset. The backtest should be a method of validating the already sound principles of a theory, instead of a method of finding an edge. For example, testing random historical RSI parameters to see what works might not be a good idea. Instead, maybe your theory is that the top 5 mentioned companies on Ape Wisdom experience more momentum because retail interest evolves into echo chambers on social media. You could use the RSI at different levels to measure that momentum, but the actual theory is the important part. There's this hedge fund, Artemis Capital Management. They have some publicly available research about crippling deflation, runaway inflation, the implosion of the global economy, the usual stuff. I'll put a link in the description if you want to read it, but there's another really interesting idea they put forward. Everyone you know who's interested in finance has existed in this window of prosperity. Forget the past 10 years. Even the past 40 years have been a really unique period of economic development.
It's amazing to think that the last 40 years have been one of the most explosive and incredible periods of asset price growth in human history. To understand this, think that over the last century, 91% of the gains of a classic stock bond portfolio have occurred during the 22 years between 1981 and 2007.
Beyond that, looking at the age demographic that watches this channel and most of the finance content on YouTube makes you realize that a lot of us have never been legally able to invest in anything but the greatest bull market of all time. So while it's interesting to look at these backtests, I can't help but wonder, what happens now? The past appears to be a predictably unpredictable predictor of the future. In hindsight, things look simple. In reality, the only certainty going forward is uncertainty. I feel like there have been a lot of words in this video, but nothing has actually been said. The market is the smartest thing ever. You guys ever heard the idea that because pi is an infinite non-repeating decimal, it contains all information? There's some technical nuance there that makes that not entirely true, but you get the idea. That's how I imagine the stock market. Everything you know, all the things you don't know, the secrets of the universe, are all encoded and priced into AMD's share price just to keep anyone from ever making money. Looking at backtests with huge performance is a really sad pastime. It's more of a hobby than anything useful. My trading, more of a hobby than anything useful. This channel, more of a hobby than anything useful. That's all for today.